Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are discussing part two of the real estate cycle, the 18-year real estate cycle. And this time we'll recap where we left off from the first video. Had a good amount of feedback, so I thought I'd dig into a bit more detail of how you can also overlay the Australian stock market, the ASX200, to help you better gauge of where we are in the market based off history and where we could be leading moving forward. So recap, most of you are aware of the GFC, global financial crisis in 2008, which was a land-driven downturn brought on by interest rates rising. Too many people were speculating prior to the 2008 crash, and people defaulting on loans, companies defaulting on loans. And then we had a good 3 to 4 years of reckoning before the cycle completed. And then we then commenced into our current cycle, 18 years. So this information has come from these two books, The Secret Life of Real Estate and Banking by Philip J. Anderson and Boom Bust by Fred Harrison. Study over 200 years of history of the Australian, US stock markets and US markets in real estate and in the stocks and commodities as well. So I suggest getting a copy of these books. They run through, there's an 18-year underlying cycle. These are the past three. The yellow marker is where we are today, coming out of the mid-cycle slowdown. So there's 18 years of 14 years up and 4 down. The mid-cycle slowdown, the stock markets take a 50% hit, property tend to 5 to 10% hit. The larger major land-driven downturns, a 4-year downturn where the stock markets can take even bigger hit of 50 to 60%. And then property also can take residential between 20 and 30% slowdown, and commercial assets can take even greater downturn based off history. So from the current cycle, which commenced in 2012, 7 years on, brought us to the peak of 2019. We then had COVID, which is a mid-cycle slowdown. We're now recovering out of COVID, and we are now positioned into the land boom, which will see us through the next few years peak up into 2026, which was 14 years from the commencement of this current 18-year cycle in 2012. So 14 years up from 2012 brings us to 2026. And then we'll go through the major land-driven downturn, which will be 4 years of reckoning for stock markets and the property market. So quick overlay, Lehman Brothers in 2008 was the 4th largest investment banker in the United States, went bankrupt in 2008 due to having too much exposure in the subprime mortgage space, hence why they were broke. 1991, Donald Trump. This is in the land-driven downturn prior to 2008. So 1991 recession we had to have. Donald Trump, heavily leveraged in his casinos in the United States, had about 4 or 5 casinos, and his revenues that he was receiving from those casinos weren't servicing his loans. So he had to go bankrupt on those casinos. And then in 1972, another pinpoint in history is where Harry Triguboff, the largest Australian residential developer, was heavily leveraged with Citibank in 1972, which was also the land-driven downturn prior to 1991 recession we had to have, which is another pinpoint time which indicated this land-driven downturn. So, quick disclaimer, this is by no means financial advice. It's general information in nature. Before taking any action, you should seek third-party tax, property, investment advice. We'll now overlay the 18-year cycle on the stock market. So the stock market moves concurrently with the 18-year property cycle, which we can then now use as an indicator to show where we are and where we are potentially heading based off history. So the current cycle, we'll just go back to our 18-year cycle. We can start 1994. So this was after the 91 recession we had to have, which most baby boomers lived through, brought on by interest rates hitting 17.5% in 1989. We went through a major downturn. That's when Trump had to fold on his casinos. Major land-driven downturn. We recovered out of that into 1994. 7 years up brought us to the peak of 2000, 2001, prior to the Olympic Games. So if we look at the ASX, 1994 was the final year that the price cycle completed. 7 years up brought us to the peak in 2001. We then went through the dot-com bust, which is similar to the COVID mid-cycle slowdown, which we just experienced. And then that was completed into 2003. And then years ending in 3 are traditionally a year of transition from a bear market. So the bear market of the dot-com bust, years ending in 3, transitioned out of the bear market and then led up into the bull market, this is the land boom, into the peak of 2007. And then that's the peak. And then there's 4 years of downturn, which is the reckoning. So the stock market takes a 50, 55, 60% hit and takes 4 years to recover. And then that brings us to 2012, which is 2012, right back at the start of the current cycle. So 1994, lead up into the peak 2000, 2001, slow down into 2002. And then as I just showed you on this ASX, the bull market run up into the peak 2007, and then reckoning down into 2008, 9, into 2011 to recover, and then the commencement of the current cycle in 2012, 7 years on to the peak in 2019. So if we go back to the ASX, from 2012, 7 years on, brought us to 2019 peak. So this is just before COVID hit. So 7 years on, 2019 peak. So 2019. So years in 2019, I even personally remember I had all my stocks super in cash because we were due for a good 50% hit in the stock market. From it peaked in 7,000, just over 7,000 points, down to 4,800 points. So a good 30, 40% hit within the years of 2020. So this was COVID mid-cycle slowdown. So even though COVID was a black swan event, we were due, based off history, we were due for the mid-cycle slowdown. This has been happening for the last 200 years and will continue to happen as the global economies continue to connect and move forward in westernized economies. So we went through COVID slowdown from 2019 peak, good time to buy real estate, good time to negotiate property for less than what they're asking. There's literally no competition because everyone's scared, running for the hills and thinking that the worst is coming. But this is perfect time to buy property, just like it is when it's summer and you go to buy your winter clothes in summer, or you buy your winter clothes, you buy your summer clothes in winter. Do the opposite, the contrarian investor. If you're a value investor, the best time to pick up value is during the slowdown, mid-cycle slowdown, and definitely the land-driven downturn. So we went through COVID, as we all are aware of and have experienced, and then now we're recovering out of COVID in 2023. To bring back here, so we recovered out of COVID. 2023 is now a transition year. So this is looking very similar now to 2003, when we recovered out of the dot-com busts in the 2000. So if you look at 2000 and from 2001, 2002, 2003, this is exactly pinpoint where we are today based off history. So September 2003 is where we're recovering out of COVID, which we've just had in the last few years. So we're recovering and stabilizing. So there's a good rise out of the immediate drop. And then it comes back a bit in 2002, ending in historically a down year for markets. And now 2003 is a transition year. So it's now rising. It hasn't hit past the peak, but we are now stabilizing out of the disruption we had through the mid-cycle slowdown, which in this case is COVID. And as you can see, based off history, what is next is now stabilization. Mainstream media in 2000, in years ending in 4, years ending in 5 and 6 are very bullish years. And then we'll peak late 2026, early 2027, based off history. We are sitting here now, stabilized. So we see it now the next few years, both being ASX, stocks, and commodities, banks, and real estate, based off history, is now a good opportunity for the times ahead. So anyway, thought I would overlay the 18-year cycle to show how you can use the knowledge of the 18-year cycle to play your best investments, both stocks and property, and how you can visualize it here through the ASX and where it'll lead us in the years ahead. Thanks for watching. I'll see you next time.